Question 25. Please read the question by yourself. Now I'm going to go directly to the questions. The question asking for the consolidated totals for each of the account balance over here. And to solve this question, first let's prepare the fair value allocation schedule. Based on the first sentence, we know that there are some assets on subsidiaries book that have different fair value from book value. And we know there are two accounts that have different fair value from book value. The first one is equipment, which is undervalued by 60,000. It has 10-year remaining life. So every year there's going to be $6,000 excess annual amortization expense. And second one is franchises, which is undervalued by 80,000. It has 20-year remaining life, which means that each year there's going to be $4,000 excess amortization expense. And in total, that's going to be $10,000 we need to consider for the annual amortization. Alright, so next, for those intra-entity transactions, let's have a look at them one by one. The first is related to the inventory transfer. And we know that there are inventory transfers from 2016 to 2018 because we are trying to figure out what's going to be the balance consolidated total for those accounts at the end of 2018. So which means that 2016's information is not relevant. So, but for 2017, we do need something from 2017, especially for inventory, because we want to know how much gross profit is deferred. So in 2017, there's going to be an entry G, the deferred gross profit related to the inventory transfer. So in order to get the deferred profit in those unsold inventory, first we need to calculate what's going to be the gross profit margin, and the way we calculate that is we use the profit equal to the transfer price minus cost and divided by the total sales or the transfer price, which is 40%. And as to the deferred gross profit should be 40% of the remaining inventory. Okay, so that should equal to 35,000, the remaining inventory, and times 40% gross profit margin. We get 14,000, which will be the deferred profit. And also, we credit inventory because inventory is overstated by 14,000. All right, so when we go to 2018, so the first thing is to recognize those deferred gross profit. So we debit return earnings 14,000 and credit cost of goods sold to recognize the deferred gross profit from last year. And second entry is the entry TI. So entry TI is to eliminate the intra-entity sales amount. So debit the transferred amount of 92,000 in 2018 and credit cost of goods sold 92,000. And the last entry is entry G. Entry G is to defer this year's unsold inventory. So in this year, we have the first, also we need to first calculate what's the gross profit margin related to 2018's inventory transfer because they have different transfer price and cost. And still numerator is the profit equal to the transfer price minus cost and divided by the total transfer price of sales. And 25% is the gross profit margin, and we use 25% and times the remaining balance of unsold inventory, and we'll get the amount of the deferred profit. That's 12,500. All right, so that's all the consolidated entries related to the inventory. Next, let's move on to the buildings. Here, there's also so one more thing is about the transfer. So for the inventory transfer, it is upstream, right? Transferred from Branton to its parent, so it's upstream transfer. Inventory transfer is upstream because it's going to impact how much we are going to adjust for the subsidiaries net income when we calculate the non-controlling interest amount for that can be allocated to the non-controlling interest. As to the buildings, Allison sold Brandon a building, so which means that for the building transfer is downstream. Okay, so still, even though we only need to 2018's entry, but it's going to be helpful to have 2017 prepared as well. So 2017 is the year when the building is transferred. So during that period, on January 2017, Edison sold Barrington building for $50,000, but that only have $30,000 selling price and $30,000 book value, which means that in this transaction, Edison get a $20,000 gain. Okay, so then we are going to use entry TA to eliminate this intra-entity gain. And also because the building is overstated by 20,000 in this transaction, also we need to adjust the building to its actual cost or actual book value. Okay, so debit gain on sale and credit buildings. And also related to this overstated building, because it's overstated, then every year there's going to be excess amount of depreciation expense related to that overstated amount. And that equals to the overstated amount divided by the remaining life, 5 years, which give us $4,000 excess depreciation expense. So we are going to use this entry ED to eliminate this excess depreciation. So we debit accumulated depreciation and credit depreciation expense. So just like we reverse that transaction or that journal entry. All right, so 2017's consolidated entry select preparation for us to prepare 2018's. So in 2018, we're going to prepare as entry star TA because this is the second year, so we use star. And the first step is so star TA is also similar to the entry TA. We want to use this journal entry to bring the buildings to its true book value. And because it has been 1 year later, which means that after 1 year depreciation, it's new amount we need for this credit amount will be 16,000. It equals to 20,000. The overstated amount minus 1 year depreciation expense. That's 16,000. And second entry is the entry ED. Just means that it's the second year. And but because they are using straight line method, so the annual amortization, the depreciation is the same every year. So that's still 4,000 for this journal entry. All right, so that's the consolidated entries we need for the building transfer. Okay, so then let's move on to answer questions. Questions asking for the consolidated total for each of those accounts, and then let's see what's going to be their consolidated total. First, sales. So sales should equal to their current book amount. But we need to adjust for that intra-entity inventory transfer, that's this transaction. So we debit sales, which means that we are going to minus 92,000 equal to 1,008,000. So 1,008,000 is the consolidated sales. Next one, cost of goods sold. And we still first to add their current book value, and then we're going to in 2018. So we're going to minus the 14,000 in star G, and then minus 92,000 in entry TI, and then plus this 12,500 in entry G. Okay, so we're going to have three adjusted amount. Is first minus 14,000 minus 92,000 and then plus 12,500 equals to 566,500. Next one, operating expense. Operating should equal to its current book amount and minus this entry star ED's excess depreciation expense 4,000, and there's one more adjustment is related to this excess annual amortization expense, and for them that's going to increase our annual amortization expense, so we need to plus 10,000 over here. Okay, plus 10,000 equals to 206,000. Investment income, the consolidated total for investment income is 0. We are going to use entry I to eliminate any investment income. Well, next one, inventory at their current book value, and then minus the overstated amount of the inventory, or from entry G, that equals to 287,500. Next one is equipment. So for equipment, we use their current book value, and then we'll come back to this schedule as well. So for equipment, we have this allocation amount. Also need to consider this excess annual amortization for 3 years. So what we are going to do is we plus the 60,000, so plus 60,000, the initial allocation, and then minus 3-year depreciation expense. Okay, give us 292,000. The last one is the building. So first we combine their current book value, and then we minus 16,000. So this is from entry star TA to bring the building back to its actual book value, and then plus the 4,000 reversed accumulated depreciation from entry star ED. Okay, so equal to 528,000. Okay, so that's for this question.